All right, welcome to Financial Accounting by Coach Samuel Ibanda. We are going to go through a question on preparation of financial statements. And this question is derived from one of the CPA papers, Certified Public Accountants Examinations paper for September 2022. So question 6 is what we are going through. In case you have this paper, you can be able to open it. And for my friends that all right, I'm trying to share the paper with you on the WhatsApp group for those that may not have it. And my assumption is most of us basically have it right now. I encourage you to ensure that you go through some of these papers, at least by the time we get to the examination. Make sure you've gone through at least maybe the last batch of papers, maybe the last 10 batches or whatever. At least if you go through some of those papers, you build your confidence, and by the time the paper actually shows up, you're at least somewhere in terms of progress. And one of the things that I will still tell you is that the examiners don't set any new things. All these things definitely come from the past paper questions. So ensure that you acquaint yourself with how questions are set so that they can help you build your confidence accordingly. Yeah, so I've shared the question. Those that are watching the recording of this, you can be able to find the question WhatsApp group, or you can be able to download this from the ISPA website. So let's go through our question and see. So the question was saying, explain 4 limitations of financial statements. 4 limitations of financial statements. We've already said that financial statements, one of the limitations, they are historical in nature, and they may not provide information of how the future will look like. So that would be one of the aspects you could note. And please make sure for these revisions, at least have a counter book to be able to rate these things as we go through them, so that you don't just listen through the recording. At least have somewhere you note, and you're able to, even for the calculations, I would like you to walk through the journey. Don't wait for the recording. Make sure that you're calculating the question as we proceed along. So aspect of historical is one of them. Another aspect is to do with financial statements. Well, preparing financial statements, we make some estimates as well. Estimates could be around depreciation, bad debts provision, and more other that we also make estimates. So that could be a limitation because managers might use that as a loophole to manipulate some of the financial information. Another limitation was that financial statements also cover a given period, so it may not be able to have may not be able to give us a picture of what can happen beyond just the financial information. And then one of the other aspects is that the financial statements also take into consideration information that cannot be basically that we cannot easily. Okay, it basically takes only information that can be financial, can be basically has a monetary element on it. If, for example, an aspect is not monetary in nature, such an item can actually not be included within the financial statements. So there's that limitation. So we cannot easily represent, for example, maybe customers' dissatisfaction or satisfaction within the financial statements to show the other party what is exactly the qualitative information. So they are basically, their focus is so much on the quantitative information. So you can think about more other limitations, you think. Of course, other limitation is that their financial statements, they require technical competency. Not anyone can interpret the financial statements, okay? Yeah, so that could be also one of the issue. So then we proceed to our question, which says the trial balance below was extracted from Salongo and Sons Hardware for the year ended 31st December 2021. So we have accounting title, then we have debit, then we have credit. So this is a trial balance, and we understand that a trial balance is usually prepared in our accounting process. A trial balance is prepared after we have balanced off our ledgers. So we have capital. Capital is part of equity and it is owner's contribution to the business. We know very well that capital has a normal credit balance, and that is why we are seeing this value being included on the credit side of our trial balance. And then we have inventory as at 1st January 2021. Now, as we see here, we agree that our end of year is 31st December 2021. So if they are giving us inventory as at 1st January 2021, then we know very well that this inventory is opening inventory. That inventory is opening inventory. And then we have accounts receivables and payables. Now, accounts receivable and payables have been bundled together. But as you look here, you see the 94, and then you see the 89,350. Now, you need to understand something here, that sometimes the examiner does this, where they put these, they don't separate these two values. They want you to determine on which one of these is accounts receivable, which one of this is accounts payable. But as a student of financial accounting, I believe that right now you understand that 94,000 is for accounts receivables. Why? Because accounts receivables are assets, and specifically they are current assets. And current assets have a normal debit balance. And then 89,350, the 89,350 for it is basically payables. So this is accounts payable. Why? Because these are liabilities, and liabilities have a normal credit balance. And then we have our purchases and sales. Now, this is also another area where the examiners combine the two things in the same line. So yours is again to understand that the 467 relates to purchases. Why? Because purchases have a normal debit balance, whereas sales is the 715. Why? Because sales have a normal credit balance. Now, it is not obvious that if the examiner says purchases, because it is the first word here that the first amount is actually purchases. No, they can actually even say sales and purchases. So it's you to know that whenever they combine, let's say purchases and sales, for me to know which one is sales, which is purchases, I base on their balances, understanding that this one has a normal, maybe debit balance. This one has a normal credit balance. Okay, so that is something good for us to take. Now, one of the other things that we also need to appreciate. Now, when we come here, we see discounts. Discounts are also in two times. We have what we call discounts allowed, and we have what we call discount received. So you can see we have the 7,780, and then we have the 10,600. Now yours is to tell me which one is discount allowed and which one is discount received. Now, for you to determine which one is discount allowed and which one is discount received, we base on still their balances to understand what is discount received. Discount received is an income, and income has a normal credit balance. So discount received is the 10,600. Which one the other is? Which one do we also have? We have the discount allowed. So which one is the discount allowed? It is the 7,780. Why? Because discount allowed is an expense, and expenses have a normal debit balance. So that is very important for you to take home. Then we have our drawings. The drawings, which is 12,000, drawings, which is 12,000, has a normal debit balance. This one is obvious since they have left it as one item. We also have salaries and wages. Salaries and wages, these are also expenses. That's why we have them on the debit balance. We have trading license. Trading license is also here. It has a debit balance because it's an expense. Then we have electricity, which is 16,750. Now, electricity is an expense in its own, okay? That is why it has a normal debit balance. And then we have the other one is carriage outwards. Now, the word carriage outwards basically means goods are going outside of the company. Carriage outwards is related to sales. It's basically a delivery cost to our customers. We also have what we call carriage inwards. Now, as carriage inwards is for us being, carriage outwards is for delivering to our customers. Now, carriage outwards is actually included within our expenses. Carriage outwards is included within our expenses. We'll also know that carriage inwards, for it, it's not included in the expenses. Rather, it is added to our purchases, okay? You need to know the format of how each of these two are treated, okay? So carriage out was an expense, and that's why we are seeing it here with the debit balance, okay? Now we have the delivery truck at cost. truck is all right. Apologies for that break, but I believe that we now back. So we had talked about the furniture and fittings. Then the next one, which is our rent, which is also an expense. And then we have accumulated depreciation. Now, like I commented, each of these assets whenever they give you their values at cost, yours is to think about what is the accumulated depreciation for these assets. Because you know very well that when we get to the balance sheet, which is our statement of financial position, we basically take we basically take the net amount, which is the net book amount. So the net book amount, looking at the cost and accumulated depreciation. All right, sorry, my network is a bit poor, but I hope we can be able to do something. So saying retained earnings, this is also called accumulated profits. It's basically profits that have been gotten in the previous periods. So this is included within your balance but we will be able to add the profit for this year as well on this retained earnings 1,600. Now you can turn back as a debit balance. So let's see, they're telling us that closing inventory as at 76 million. Now, if you remember very well, in our trial balance, they gave us opening inventory of 142,109. Now, each of these inventory balances have an importance. This opening balance is, we usually use it when we are determining cost of sales only. Entry as at 31st December 2021, which was valued at 76 million. Now, this closing inventory is what we use while we are preparing our so-called balance sheet or statement of financial position. This is the inventory that we record under our current assets. Okay, so it's very good for us to note that. Then we have, they're telling us that a customer deposited 15 million on the business bank account for building materials on 1st December 2021. The materials had not been picked by 31st December 2021 because construction had not yet commenced. Now, this customer paid in advance. Okay, and whenever have not delivered, we usually call that 15 million is actually accrued income. Okay, because we have not yet be still a liability in our books of accounts. This 15 million is a liability in our books of accounts. Okay, and again, they are telling us that casual workers wages of shillings 4.4 were outstanding by the end of the year. Casual worker wages of 4.4 were outstanding by the end of the year. Now, these are accruals, accrued. We're going to have accrued that we need to note in our books. So this will also be under our current liabilities. Then they're also telling us that the trading license was paid to cover 1st October 2021 to 30th September 2022. Trading license was paid to cover period 1 of 2022. So the trading license is an expense and if they are telling us that it was paid to cover period 1st October, a part of the year beyond 31st December 2021. So anything that is beyond 31st December 2021 for trading license is actually a prepayment, okay? It's basically a prepayment, and prepayments are usually treated as assets, specifically as current assets. Then they are telling us that Salongo decided to write off a debt of 3.4 million for a customer who could not be traced for the last 3 years. Debts and what we call bad debts written off. So the Salongo, this debt he wrote off is by bad debts written off, and then he went ahead to make a provision for bad debts. Then going on, telling us that 20 pieces of iron bars costing 65,000 were stolen from the yard during the year. So we also have to provide for a double entry for this item. Usually whatever they include in the additional information, we have to take into consideration of the additional information and prepare the respective accounts and make the respective adjustments. Then they're also telling us that the business depreciates non-current assets at the different costs, at cost. Now, this statement is very important. Depreciates non-current assets at cost is very important because it tells us the type of depreciation method we are going to use. So in this case, we know very well that we are going to use the straight line depreciation method. So we have delivery truck, 20%. Then we have furnitures and fittings, which is 5%. So they're asking us, prepare for Salongo and Sons Hardware Enterprises. 1, a statement of profit or loss for the year ended 31st December. And they want us to prepare a statement of financial position as at 31st December 2021. So I'll just try to use my Excel for us to prepare our respective. Now, usually for such a question, it's very important that you first tackle, basically tackle our so-called additional information, okay? Just a moment. All right. So our additional information, the first additional information, okay, maybe could just come here. So Salongo and hardware business. Let me just try to do this. Come here. This is where my solution is. And I'm going to do my working. Now, sometimes they ask you to generalize the additional information. Sometimes they don't. In this case, they didn't. So we shall just move directly to our statements. So Salongo and Sons Hardware Enterprises, since they asked us to prepare what we call a profit and loss, we shall just include it there. Statement of profit and loss. Statement profit and loss as of that date, as at 31st December. It's for their period ended 31st December. Now, usually for the P&L, we say for the period ended 31st December. Well, when it comes to the balance sheet, we say as at. So this is what we have for hardware. I usually encourage my students for you to manage time. You can actually do these statements. You can create a page and maybe a half or leave maybe like 2 pages or 1 page, or I think 2 pages would be better. Then you also do you also write the heading for your statement of financial position as at. Reason, because you want to move concurrently, okay? And then you also create your working page after those, let's say 4 pages, okay? No one will really penalize you for leaving space. You just cross a line where there's no information. So we know very well that when we are preparing our profit and loss, what do we usually start with? We usually start with our sales for the period, okay? So we start with our sales, less cost of sales. So our sales, we determined our sales were 715. So you just go to your P&L and say sales. This is amounts. So you can create 3 columns depending on how you want to organize your work. Okay, or 2 columns, those can also be enough. Usually, our sales, we less any sales returns, just in case we have them. But the good thing here, we don't have any sales returns. What we basically have are the carriage outwards, which we say that the carriage outwards are included within our expenses. So we have our sales. We're now going to less cost of sales. Say less cost of sales. Say less cost of sales. Less cost of sales. So we know cost of sales is opening stock then we add purchases. Opening stock, add purchases. So we go back to our question to look for our so-called opening stock. So this was our opening stock, which is 142,109. So you take it there. Now for us to see that we are a bit organized, yeah, you can basically use this column, or you can use this column. This is also okay. Maybe what we could do is we can push our sales here and then work from here. So our opening stock is 142,109. Make sure you're also doing the same thing on your side within your, as you follow, as you write. There's power in writing while you're following. You can even proceed with some of the things as well. After we have done our add purchases, we should proceed to get our purchases value. Purchases, still you get them from the trial balance. Our purchases were 467. So you pick the 467 and bring it here like that. Now, after purchases, we have to list some items, okay? Now, this is what you started with as stock. This is what you have at purchases. Now, the generic way of handling P&L is that we list closing stock. But before we list closing stock, yours is to analyze and ask yourself, is there anything that affects my stock other than closing stock? Was there anything that happened out of the norm that might have affected my stock that is outside selling? It was not basically a sale, but it affected stock. Now, if you remember, within our additional information, we realized that we had some inventory that was stolen. So that inventory would affect it would ideally affect our cost of sales. So we have 20 pieces of bars that were stolen. So these 20 pieces, we have to adjust them onto our so-called calculations. So they are telling us that 20 pieces of iron bars, each costing 65. So each costing 65 means that for you to determine the total value will be 20 times 65. Okay. So you come back to your working here, working one. These are on iron bars. Stolen. These were 20 at 65,000 each. So it means their value is equal to 20 times 65, which is, they're giving us a 1.3. So what does that means is that whenever they steal, whenever iron bars are stolen, or whenever you lose stock in an organization, you have to think about what could be the double entry for such a transaction, okay? What does this transaction exactly affect, okay? So this transaction affects your stock. It affects your stock, and then you expense this to basically be an expense that you will take in your what? In your operating expenses. So the double entry is we debit stock inventory. Sorry, we don't debit inventory, we credit inventory. We debit the P&L, the profit and loss, and we usually take an expense called, you can call it stolen iron bars, because it's an expense, and expenses are debited when they are increasing. Whenever you see somebody saying debit POL, they are basically saying put that item under expenses, okay? And then we have credit. We credit our inventory. The reason why we're crediting our inventory is because inventory is reducing. Remember, assets, whenever they are reducing, we credit them. So with 1.3, like that. So here I'll come here and say, since I've written add purchases, I'm going to less stolen iron bars. So how much am I removing for stolen bars? Is they said 1.3. So I just say 1.3. Now remember, these are the values I was getting them from the trial balance, and the trial balance already has a degree of precision. When you look at these values, they're in a thousands. These values are in a thousand. So it's very important that you also include the same in your calculations, just to show the examiner that whatever you're working with is in a thousand. So that is very important. And you can include those on the headings or on the respective amounts. So that's why I have now my 1.3. Just move these decimal places, they're not there. All right. So after removing the stolen iron bars, now I'll do what every one of us knows is less closing stock. If I didn't have any stolen iron bars, I wouldn't have less them here. I would just go directly to less closing stock, or you call it closing inventory. Inventory and stock have similar words, but for our okay, here they have called it inventory. So you can call it inventory, okay? But if no one, they're not penalized if you call it stock as well. So closing inventory, they gave it to us in the additional information. When you come to the additional information, closing inventory was valued at 76 million. So I'll just come and denote the 76 million, which is 76,000 for this case. So 76,000 is what we do have. After that, we should be able to get what we call our cost of sales. So our cost of sales is basically going to be the net of all these amounts. Add and subtract what is supposed to be subtracted. Sorry. This is supposed to be less as well. So cost of sales is 531,809. Now, there's what we call goods available for sale. When you add your opening inventory, you can actually even use the word inventory, not to confuse you. That's what the examiner used. When you add your opening inventory plus purchases, you get what we call goods available for sale. Usually we don't usually write that here, but just in case you want to write it, it's okay, it's fine. So when you less iron bars that were stolen and then closing inventory, you become to 531,809. Okay. Then you proceed to determine your gross profit or loss. So in this case, we see that we have a profit because our sales are higher than cost of sales. So this minus this, it gives us 183,191. So that's our gross profit. Now, after gross profits, we should add other incomes. So we should ask ourselves, did this business make any income other than the gross profits? So other incomes are also gotten from our information. You go back to your trial balance and see if you have any incomes. Other incomes could be commission received. They could be discounts received. They can be interest received, rent income, just in case maybe the business also rents out some space, and so on. So in this case, the only income that I see here is a discount. Remember, we said that discount is discount allowed and discount received. So since these discounts, they gave us two values, we said the 10,600 was discount received because incomes are usually on the credit side. So I'll just pick the discount received. I'll just come here and say discount received, and I'll denote the value, which is 10,600. So I hope you're following. Then after that, we usually get what we call gross income. So our gross income is this plus this, which gives us 193,791. 193,791. Then after that, we now less expenditure, operating expenses. So expenses also are gotten from our information here. When you look at what we have here as the information, here's an outlook for the expenses. Capital is not an expense, inventory not an expense, accounts receivable is not an expense, purchases are not an expense. The next expense is discounts. Discounts, and here discounts, we are going to basically take the discount allowed, which is the 7780. So just come here and say discount allowed is 7780. And then after the discounts allowed, we are going also to look for other expenses. Drawings is not an expense, okay? Let's do salaries and wages, they are expenses. So salaries and wages, we have 45,595. But I remember that in our additional information, we have some information around salaries and wages. So they told us that casual workers wages of 4.405 were outstanding at the end of the year. So it means that we are going to add this 4.405. We are going to add it to this 45,595. Okay. So what we shall do is come here and say salaries and wages. So just basically write here. Now, in this case, this question had very few marks. where they did there were very few marks for the workings, so you can always basically maneuver through and just write these, just make these additions from here. So this plus so 4,405. So like that. So this gives us about 50,000. So go back here. So we're going to record now the next expense, sorry. So the next expense is trading license. So trading license. Now the trading license also had some additional information. So you cannot just take this value. So yours is to ask yourself, what is the additional information in the trading license? So we have the 3,200, but we have to adjust something. So they are telling us that the license was paid to cover a period of 1st October 2021 to 30th September 2022. So this is 12 months from 1st October 2021 to 30th September 2022 is definitely a period of 1 year. But then we should only take what relates to the period ending 31st December 2021. So when you look at the period 1st October 2021, how many months were remaining to the end of the year, to 31st December 2021? So we have October as a full month, 1 month. We have November, which is our second month. Then we have December, which is the third month. So this trade license that was paid, which we have in our trial balance, we are only going to consider for 3 months in our books, because the balance is a prepayment for next financial year. So what I'll do, I'll just do a small working. I'll just come here and say working 2. This is trading license. So we have debits. Now, okay, let me say what was paid is the 3,200. How am I getting the amount? I'm getting the amount from here, 3,200, basically 3,200,000. Okay. 3,200,000. I will add the 3 zeros here. So I first get the monthly, which is 3.2 divided by 12. So it gets me to 266. Then I'll say for 3 months of 2021, the period we are looking at be basically this times 3, which is 800,000. And then for 2022, Okay, this is for period 1st Jan to 30th September. 30th September 2022. It will be this monthly times the remaining months, which is those will be how many months? They will be basically 9 months. So the total amount is 3.2. So this I'm going to recognize it as my expense. The 800,000 will be my expense that I'm going to recognize. So I'll just come here and recognize 800 as my expense, and I'll direct this to working. You tell this examiner that working 2 is the one that has this formula, this value that you have there. So they can always refer back to here. So that is for the trading license. Now, the next one is electricity. Let me just try to remember that if we had any additional information on electricity. Electricity did not have any additional information. So electricity, I'm going to pick the amount as the way it is. $16,750. Okay. Sorry. So electricity is 16,750. So next, carriage outwards. We also don't have an additional information on this. So I'll just carry that and come here. So carriage outwards is 63,200. So there was no additional information on that. Let's also see. Now expenses, these are not expenses. I'll first jump them, then I'll move to rent. Now rent, I remember had an additional information as if I'm not forgetting. Did it have? No, we didn't have any. So I'll just carry rent. Rent 19,200. Okay. So rent is there. And then we have they are telling us accumulated depreciation and retained earnings and ABCD. So the other expense that we are going to calculate is depreciation. Okay, for these trucks. So let's come here. Our working and say working 3. Working 3, depreciation. So we are going to, we have this. So let's start with the delivery truck. So remember, they told us that depreciation is they told us depreciation is a straight line. They told us depreciation is at cost. Whenever they say is at cost, you know that depreciation is at straight line. If they say depreciation is at net book value, then you know that depreciation in that case is supposed to be at reducing balance. Okay, so that is important. So delivery track is at 20%. So depreciation is 20%. Remember the costs here is at 148. So to calculate depreciation, percentage of depreciation times the cost. So this will be equal to 20% times 148. I'm going to add the other zeros. 1, 2, 3, 1, 2, 3. Remember, you have a degree of precision over 1,000. So this is now the zeros. I've also added them. So my answer here is just basically 20% times this. So just press your calculators accordingly. I believe right now you have your calculators. You can share your answer in the chat box. So it is, I'm getting 29,600. So depreciation for the delivery van is 29,600. Okay. I hope you get the same thing as well. So just come here, say depreciation. Say delivery van 29,600. Sorry. Then let's look at the furniture. Now the good thing is the depreciation in this case is for the same method. So say depreciation delivery track. So it is depreciation is equal to that. So I'm going to have my depreciation equaling to the percentage for the depreciation for furniture and fittings is at 5%. So 5% times the cost for furniture. Furniture had a cost of 15 to 14. Now, we are not yet using these values, remember, of accumulated depreciation. We are going to use them at a certain level. Here we're calculating the depreciation for the year, okay? So that is important. So 15 to 40 is our cost. I'll add the 3 zeros. So this will be so this gives me 762. 762. So I'll come here and say depreciation, furniture and fittings is 7. Sorry, I think I was calling this delivery truck. This is furniture and fittings. Thank you. So this is 762. Okay. So that is what we get. And we'll come back here. We've determined the depreciation for these two. Let's move to see if we have another expense. So this one is a prepayment, which we shall going to use we are going to use this on what? When we are doing our balance sheet. Now let's just move. Trading license, that one we've affected it. Now we have this one, which they are saying, so long we decided to write off bad debt worth 3.4. The customer who could not be traced for the last 3 years, and create a provision for doubtful debts to 5% of the remaining receivables. So we have two. I said we have the provision, we have the bad debts written off, and then we have the provision for bad debts that we have to make. So our working for we have bad debts written off. Now, whenever we are writing off bad, we have two things, and maybe I could just give you more explanation here. We have what we call provision for bad debts, and then we have what we call bad debts written off. Now, the reason why we have provision for bad debts and bad debts written off is because the customers we sell to may sometimes not pay what we give to them. They don't pay for the goods. So for us as a business, there's what we call prudence concept, where we say that a business should cater for any losses and should not overestimate its revenue. So the bad debts written off, usually we have two classes of customers. We only write off a customer when we have all the reasons to understand that this customer is not going to pay us. And I gave you an example, like a customer who has let's say moved abroad permanently, or a customer who has died. If it's a business that has been declared bankrupt, such customers will write off what they were going to pay us, and we call it a bad debts written off. Now, for customers that are just have doubt, basically customers either who are broke or who are sick, customers who are in a state of doubt, where we're not sure of whether they will pay us or not, or it's a business that is struggling, we make a provision for it. That's why we call it a provision for bad debt. So we're making a provision that just in case this customer does not pay us, this is the amount of money that would remove from our profits. Okay. So in this case, since they are telling us that Salongo decided to write off a debt worth 3.4 for a customer who could not be traced for the last 3 years. So this customer was worth the write-off because we cannot wait any longer. Okay. So, and then they're telling us and to create a provision for doubtful debts to 5% of the remaining receivables. Now, whenever we have a customer whom that customer who is not going to pay, and we've either they are not traced or a BCD, we usually have the double entry is we debit bad debts with, now in this case, the customer is worth 3.4. So that means that this will be 3,400,000. And then we credit our receivables. Receivables are what? Receivables are our debtors, okay? Receivables are debtors. So the reason why you create our receivables is this guy or this person is no longer traceable. So we are just removing this value from our receivables. We don't want to continuously hold our receivables and say that we have these guys that we demand. Even you as an individual, you can no longer say that I demand this person when this person is not traceable. Remember, we had our accounts receivable here. So our accounts receivable is 94. So included in this 94 is that guy who cannot be traced. So we are crediting to remove that value from here. Okay, the 94,000. Now, after we have written off our bad debts, the examiner went on to tell us that what remains after we've removed that guy, we should make a provision for doubtful debts to a 5% of the remaining receivables. Okay. So yours is to determine the remaining receivables. So remaining receivables, the remaining receivables is the 90 million, is basically going to be the 90, because we have 90, it's 94 million or 94,000 in that case. So you do 94. So this one gives us 90,600. So it means that our provision is at 5%. So 5% is going to be subjected on these remaining receivables. So 5% times 90,600, which gives us 4,530,000. So what we are going to basically do is we are going to come here and now, before I even come here, this provision for bad debts also has a double entry. We debit bad debts with 530. We credit our provision for 453. Now, as you can see here, we credited receivables because this customer was not traceable, and so we're not basically going to receive an amount of money from them. This one, we created provision for bad debts because this is just a percentage of our remaining receivables that we think may not pay us. So we create a provision for bad debts account. And that's why we credit provision for bad debts. So you come here and write bad debts. Now, one thing that you realize that we debited bad debts in both the two scenarios. So it means that sometimes, of course, some people may call this bad debts written off, but it's still the same thing as bad debts, okay? This is an expense, this is also an expense. So I'm just going to add these two values for this value here. So this is 3.4. 3,400 plus 453. 4530. Sorry. So here we have about 7930. Sometimes they may separate them. Sometimes you can combine them, but I usually like combining them. Okay. So you can have this value here as your bad debts. Okay. Which is 730. Now, that is our last, is it our last expense? Do we have any other? Let's cross check and see. Remember, we had some stolen iron bars as well, which we said that they will also be considered as expenses. When we are doing our first working, we said that these iron bars we debit our P and L with 1.3. So you need to also include them as well. You just come here and say stolen iron bars 1.3. So this is what we basically have as an expenses. So you can go back and cross check and see if we have taken into consideration everything by going back to your trial balance. You look at your trial balance and also look at the additional information to ensure that you've recorded every expense. Okay. So right now we have our total expenses. Okay. Our total expenses So our total expense is 197,322. Then so we are going to have either net profit or a net loss. But since in this case we have our gross income Actually, when you realize here, you realize that our gross income is higher. It's lower. We have 193 and then we have 197. So what that means is we are going to have this minus this, giving us a loss. This is a net loss of 3.535. That's what we have. Okay. All right. So that is what we have. I'd created my heading here already for remember why I created here is because you want to create your workings after the balance sheet. So once you're done with this, you can now come to your balance sheet. Remember our balance sheet, we write assets, and assets, we start with the non-current assets. Non-current assets. And for non-current assets, we usually look at the cost, accumulated depreciation, and then we look at the net book value. So for our question here, our assets, we have these two, the delivery van and furniture and fittings. So I'll just come and record those ones here. I want you to be attentive here on how we are going to calculate these costs. Okay, the cost is obvious. The cost is obvious, 148 and 1520. So this is 15, this is 148. Now this reminds me that we need to include our amounts in thousands. Just call these amounts in thousands. It's very important for the examiner. So now we are going to calculate accumulated depreciation. Now you get to realize that they gave us accumulated depreciation as at 1st January 2021, as at the start of the financial year. As at the start of the financial year. But then we have depreciation for these assets that has happened in this financial year. So when you come here, remember under our workings, we said that depreciation was 9,600. Now just use just this, okay? Or what you could do, you can create your another working 5 and call this accumulated depreciation. So we are going to say delivery track. So we usually look at accumulated depreciation as at the start of the year, which is 1st Jan, and then we usually look at the depreciation for the year. So the accumulated depreciation at the start of the year is what the examiner usually provides us, which is 59,200. And then we add the depreciation for the period, which we got for the delivery van as 29,600. Okay, we can add 3 zeros here. 1, 2, 3. 29,600. So this is what we have. So the accumulated depreciation at the end of the year, we get 88,800, as you can see there. So that is what I'm going to record. So I'll come here and say 88,000. No, 88,800, sorry. Like that. So it means that the net book value will be this value minus that. This net book value is also called carrying amount. Okay, so just in case you see some text with such definition, that is what exactly it means. And then for furniture and fittings, you do the same thing. Okay, so I'll just pick this information here and remove this. So this is furniture. And fittings. From our question, the furniture and fittings is 1,524. That is accumulated depreciation at the start. Depreciation for the year is 762. So let me just add the 3 zeros here. Usually in the working, I encourage you to work within, make sure you add the 3 zeros since this is off the statements. So accumulated depreciation will be this plus this, which gives us 2286. 2286. I'll just come here. 2286. Is it? Yes. So when you subtract this and this, you get your net book value, which is 12,954. Okay. So you're able to get your total non-current assets because you don't have any other current assets, any non-current assets at hand. So summation of this gives you this value, which is 72. So we move to our current assets. So the current assets, we go back to our trial balance and look for the current assets. Now, when you look here, this is trial balance extracted. So you have to look for the current assets. Capital is not a current asset. Inventory is a current asset, but we don't take inventory at the start of the period. Remember, it is a balance sheet as at the end. So we take this one down. The closing inventory as of 31st December is 76 million. So just come here and write. So you write inventory. Uh, 76,000. So we go back again. It's very good for you to follow this so that you don't leave out anything. Then we have accounts receivable. So accounts receivable, we have 94,000, but you need to remember that accounts receivable, we had some adjustments. And one of those adjustments was to do with the provisions and then the bad debts written off. I want you to be attentive here and see what I'm going to exactly do. So accounts receivable, what I'm going to do, you saw here in our working, we had these bad debts written off. So these bad debts written off, we said we credit our accounts receivable. So the value in the trial balance is 94, okay? We have 94 that we have, but the 94,000, we have to remove this 3.4 for this customer who is not traceable anymore, which is 3.4. And again, we should also remove, usually we also remove the provisions for bad debts, okay? So sometimes what you could do is you can first have this accounts receivable here and say I'll use this column, 94,000 minus 3,400 gives us that. Then you come and say provision for bad debts is usually a negative. You say minus 4,530 minus 4,530. So this should give you the net receivables, net accounts receivables. So 86,070 is our accounts receivable. So once we are done with that, we move to purchases. Is not an asset, is not a current asset. Discounts, no. Drawings, no. Salaries and wages, then trading license, these are expenses. But remember, for salaries and trading licenses, we had some additional information. So I'll just first run to additional information and see if we have any asset in the additional information. So for this one, we said it's a liability. Any customer who pays in advance and does not take their goods, we shall recognize a liability. We shall record that one. This one is also a liability. Now this one specifically is an asset because we paid over and above what we were required to pay, because we paid a period covering 1st October to 30th September 2022. So what I'm going to basically do is I'm going to come here. Remember on my working, I had trading license, and I said that the trading license computation, this one for first, remember this one, we expensed it. This was expensed. This one is a prepayment. So this prepayment of 2.4, I'm going to recognize it here. So I'll just come here and say trading. Okay, or call it prepayment. Say in brackets, trading license. $2.4. Also, I'll remove the 3 zeros, so I'll just record 2.4 right there. So I believe that you understand why I've recorded that. Now I'll move again to see if I have any assets. I don't have any other asset down here. So I'll just move up again and see what do I have. So I had my salaries and wages, trading license that one I've recorded, electricity, not an asset, not an asset. These ones I've already recorded them, rent already accounted for. This one we've also accounted for, retaining earnings. These ones are recorded somewhere else. Now the next one I'm going to record is cash and bank. Cash and bank, they have given us 59,600. Okay. But cash and bank also has an additional information. There's something here. They're telling us that a customer deposited a total of 15 million. A customer deposited 15 million on the business bank account for a building materials on 1st December 2021. Now, this is something that they have shared with us here that we need to recognize, because they have told us that this is additional information. So the presumption is that this was not recognized. Okay. So you come here and say, sorry, my PC is not disturbing me here. So you say cash and bank. So I'm going to write the amount that we have, which is we have in the trial balance is 59,600. We have 59,600 plus what we have in the additional information for the customer who paid 15 million. So I'll say 15,000. So that is 74,600. This customer, I'm also, remember, I'm adding the money here on here, but I'm also going to recognize it as the liability since this customer didn't take their goods. Okay. So it's very good for you to note that. So once we have that, do we have any other assets? I don't think so. So if that is what we have as our current assets, let's proceed to get our total. Total current assets. So the total current assets are this. $239,770. So let me now get the total assets by adding the total non-current assets plus the current assets, giving me 311,224. You can put that into make sure that you put that into that. Then you come to liabilities, equity and liabilities. Now, equity and liabilities, I'll start with equity. I'll start with equity. Under equity, I'll start with capital. And under capital, I have I have 287. I'll use this column. Now, capital, the next aspect is retained earnings. But before that, we need to look at the drawings as well. Okay. So we are going to list the drawings from our capital, but we can basically denote it here. Remember our question here, we have drawings of 12,000. So come here and say drawings. Okay. Drawings. Drawings, we have 12,000. But this one is going to be negative since we are subtracting it. Okay. Then before I proceed, I just want to comment on somebody needed some clarification on what recorded under cash and bank. When you come back to your question here, I want you to observe something very small. They're telling us that a customer deposited a total of 15 million on the business bank account for buildings materials on 1st December 2021. The materials had not been picked by 31st December 2021 because construction had not yet commenced. So I'd say that this amount of money is still a liability to us because we have not delivered the goods. But the 15 million, we have to add it on our bank account because even when the customer didn't take their goods, on our bank statement, this value will actually be there. So for us to have a proper value of our cash book amount, we have to get the 59,600 and add the 15 million, which was deposited on our bank account. And that is why we have our two values added, the 59,600 that we had plus the new customer's deposit of 15,000. So that is why we have it. So we don't deduct it again. We shouldn't deduct the 15 million because this money is on our account. Okay. This money is on our account. So the cash, whatever is on the bank account, does not depend on whether we own the money or not. As long as it's on the bank account, even if it was a loan, we would consider it as part of our bank balance. So that is very important for us to understand. Okay. So I hope that is very fine, or that is helpful to you, Michelle, who was trying to ask. So drawings is that. The next aspect I'm going to record is retained earnings. Now, retained earnings, they told us that our retained earnings were at the start of the year was 69,000. Okay. Now, retained earnings change just like accumulated depreciation because we are going to add the profit or subtract the loss for the period. Since we had the loss, we are going to subtract the loss from the 69,000 to determine our new retained earnings. So this is what is going to happen. When I come here, I'm going to come here and say 69,000 subtract. So I'm going to subtract now, since we got a loss in the statement of comprehensive income, which is 3531. 3531. So this is what we have. So we have 65. We have 65, as you can see right there. I hope you're able to see the same as well. But now, one of the other aspects is, I hope I picked the right amount. Now, one of the things that I want to also highlight, and maybe this might have skipped my mind. I want you to be attentive here. Retained earnings are supposed to have a normal credit balance because they are accumulated profits. But from this question, we see these retained earnings on the debit side of the trial balance. I hope you see them. Remember, they are supposed to be on this other side. So whenever retained earnings are on this side, means that the business has been making losses cumulatively. That is why we have 69,000. So what happens is that here, this 69,000 also has to be basically a negative. So this is also supposed to be a negative. So we're supposed to get negative 69,000 minus, again, the new loss, which is 3531. Would only add up these two values, would only make this a positive if at all they had actually put it on the credit side of our accounts here. But right now, we're seeing that they put it on the debit side, so it is a retained, it's more of a retained loss. It's not, they're not basically profit. So Anna, your microphone is unmute. I don't know if you have a question to ask. Anna, are you asking a question?
No.
Okay. So that is why I've made this a negative and minus that. So in case it was a positive, you just put positive 69 minus this. But since it's now, in case it was a negative and you had made a profit up here, you then add this amount here. You do minus 69 plus the 3531. So that is very important to note. So this one will also be a negative as we seeing it there. All right. So we are done with equity. Let's look at the liabilities. And for the liabilities, we are going to look at our current liabilities. Let's look at current liabilities. Now, current liabilities, our current liabilities is, let's come here. Within our trial balance, we should be able to determine our current liabilities. So we have accounts payable. We have accounts payable of 89,350. Remember, we say that these were receivables, these were accounts payable. So this, I'm going to record it. Going to come here and say accounts payable. So that's the accounts payable. Another liability that we have, I want you to again observe very critically. Here we had salaries and wages. Now, salaries and wages, they told us there was an outstanding amount of how much? Of 4,405,000. So this 4,405,000 is a liability. You come here and say outstanding salaries or salaries accrued. You can say accrued wages. Since they are outstanding, we accrue them. 4,405. Okay. Those are our accrued liabilities. Base accrued wages, 4,405. Now we also have another liability, which I've already talked about. I said this income is unearned income, or what you can call income received in advance. It is income received in advance. Income received in advance. Sometimes it's also called deferred income. You can basically call it deferred income. So, or you can call it unearned income. Sorry, I'm writing it in the wrong place. But this was accrued wages. So it's unearned income. And income 4,405. 4,405. No, sorry, it's not 4,405. This was 15 million. So I'll say 15,000. Okay. So those are our liabilities, current liabilities. Do we have any? Okay, here you can say total equity. I worked from this column, so this can be total equity here. So total equity was this. And then you can have total liability. Since we don't have any, we basically don't have any other liability. We don't have the so-called non-current liabilities like loans, debentures, long-term loans, debentures. Those will be our liabilities, which we basically don't have. Please, if you don't have anything to say, you can mute your microphone so you don't distract the session. If you have a question, you can put in the chat box as well. So when you add this up, it gives you 108,755, as we can see that. So yours is to ask yourself, does this balance? Okay, let's just try to look here and see if we have taken into consideration everything. So do we have everything noted accordingly? You just basically go through to ensure that everything has been noted as per what we should be able to note. Okay. So that also would work as well for your liabilities as well. If everything has been noted, then you do total equity and liabilities. So you do total and liabilities. Which is summing up these two values, which is 311,224. We have to compare it with the total assets and see if it's the same. There was something here. This is not false. So you can see this was 311,224. This is also 311,224. So our balance sheet balances, which is our statement of financial position. So that is what the examiner expected you to do for this question. So I hope that you've learned something from this class, and I would be open to any questions if we have any questions for those that are attending this live, or in case you're watching a replay of this, you can be able to share either your questions within the WhatsApp group, and then we can be able to learn from each other. Michelle, Anna, James, Susan, Stera, do we have any questions? Okay, Susan says no. I hope the rest of the others. So I believe you've learned something despite having no question, and I wish you all the best. My encouragement is go and try out other questions, similar questions of the kind, so that you can master these things, the provisions, the discounts, the what. Once you do, for example, after this question, once you go and do maybe other 5 similar questions, I want to convince you that you'll actually have some stand in regards to your success when it comes to such questions. These questions always appear in exams. So make sure that you can be able to go through them. It's also very common that questions less on manufacturing, they also bring similar adjustments. You use the same approach, okay? Use the same approach, even when it comes to, let's say, maybe some questions on nanny for profit, and they give you some similar additional information. You also use a very similar approach. So I would like you to let you go and wish you all the best. See you then next class. Bye-bye.